Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of corporate filings. And today, we're digging into a company that is making some interesting moves, practically trading debt for stock. We're relooking at Jaguar Health Incorporated's latest report, a Form 8K, which is basically a heads up about major events. What is catching our eye here is a deal they made involving royalty interests and the issuance of new shares, and it all happened on the 30th of September 2025. Jaguar Health Incorporated, a company we've seen before, is a biopharmaceutical company focused on developing and commercializing innovative therapies for patients with gastrointestinal disorders and related health conditions. You might remember them from previous reports where we touched on their efforts in a pretty niche but important area of healthcare. Their common stock trades on the Nasdaq Capital Market under the ticker JAGS. This means they are a publicly traded company and have to report significant events to the public, which is exactly what this document is for. This 8K filing is primarily about unregistered sales of equity securities. So what exactly happened on the 30th of September 2025? Jaguar Health, or the company as it is referred to here, struck a behind the scenes deal, a privately negotiated exchange agreement with someone who held a royalty interest in the company. Think of a royalty interest as a right to receive a portion of the money a company makes from a product or technology. In plain English, they handed over 286,532 shares of their common stock. What did they get in return? A big chunk, $600,000 to be exact, shaved off of a debt or an obligation related to this royalty interest. This is a common maneuver where companies try to clean up their balance sheets by swapping a debt obligation for equity. It means they are essentially converting debt into ownership. This is important because it can reduce their future interest payments and move towards a more favorable financial structure. Now for the legal bit, the shares issued weren't something they sold on the open market. They were issued under a specific exemption from registration, meaning they didn't have to go through the whole complex process of registering them with the Securities and Exchange Commission. This is often allowed when a company exchanges its own securities with an existing security holder, like in this case where they adjusted a prior financial arrangement. Interestingly, the document also tells us that the actual agreement they signed, its form, was already filed with the SEC way back in 2019. This means the structure of this deal is entirely new to them, and they are likely using a pre-approved template for this kind of debt, for equity swap. Now, looking at this from a shareholder's perspective, what does this mean? On one hand, it reduces the company's outstanding liabilities, which is generally a good thing. It means they owe less money to others. On the other hand, it increases the number of shares outstanding. When you have more shares, the ownership slice of existing shareholders becomes smaller unless the company's value grows to match. It can also potentially dilute the earnings per share if the company's profitability does increase proportionally. Jaguar Health is operating in a challenging sector, and managing its financial resources, including its debt, is crucial for its survival and growth. Deals like this are often necessary to navigate financial pressures, especially for companies that are still in the development or early commercialization stages. The company is essentially balancing its need to service debt against the desire to hold onto cash. By issuing stock, they are choosing to give up a piece of the company in exchange for immediate relief from a debt burden. This is a strategic trade. That can be beneficial if the company's future growth prospects are strong enough to compensate for the increased number of shares. In terms of potential risks, issuing stock can signal to the market that the company might be facing financial strain, which could affect its stock price. However, in this specific instance, the exchange was for a reduction in an existing royalty obligation, which suggests it is more of a financial restructuring than a desperate cash grab. The real test will be whether this move allows Jaguar Health to better execute its business plan and ultimately increase its value for all shareholders. So, to sum it up, Jaguar Health is managing its financial obligations by converting a debt related to a royalty interest into company stock. This streamlines their liabilities but increases the number of shares. For investors, it is a good reminder to always check how companies are handling their debts and how new share issuances might impact their ownership stake. We will be watching closely to see how this impacts their financial health and strategic progress in the coming quarters. Alright, that is our quick dive into Jaguar Health Incorporated's latest filing. What is your take on this debt? For equity swap, does it signal strength or a potential dilution risk? Drop your thoughts in the comments below. If you found this breakdown helpful, please hit that like button. And for more deep dives into corporate documents, make sure you are subscribed. Also, don't forget to join our Discord community, linked in the description for more discussions. Thanks for watching, and I'll see you in the next decode.